It's not because there was a higher risk on the loan. It's because the lender knew they could get away with it. They were pushing the envelope. How much can I sell to this person and make them pay more than they actually should? Welcome to Getting Money Right, a show dedicated to helping you achieve financial freedom through education and inspiration so that you can be free to pursue your true life's purpose. We are your hosts, David Thompson and Leo Sabo, and in today's episode, we are talking about car loans. That's right, auto loans. What happens when you go to purchase a vehicle? What are some of the national statistics? And really, we want to lean into some shady lending practices that have been happening. Also some decisions that have been made by car buyers based on a lack of education and maybe the wrong mental framework for thinking through a big purchase. The marketing today has changed the way that we view products and the way that we buy things and how much we pay for them based on how they're marketed to us. So we're going to talk a little bit about that. So first and foremost, we're going to pull a lot of great data from Consumer Reports. Now, Consumer Reports did a year-long investigation. They looked over 858,000 loans. So over 800,000 loans that they reviewed. This is a lot of data.
Yeah.
I don't know, what investigative journalist at Consumer Reports had the time and energy to pour through this data, but they looked at over 800,000 loans across 17 major auto loan lenders. So this is not just one company or one group that is lending. This is 17 major lenders. So this isn't even just the shadiest stuff on the street. These are major auto lenders.
Right.
And they just wanted to get a basic overview of the car loan industry and how people are purchasing and what that looks like today. So we're going to pull heavily from some of the data in this report, but we're also going to share our personal opinions, some really great rules of thumb for you when you make a vehicle purchase, what you should be thinking through, and the percentage guidelines from a few different angles we're actually going to look at. So I'm excited about that. Leo, what are some of the things that Consumer Reports found in this investigation?
Yeah, so when we came across this article, it was actually on a different website that pointed to the Consumer Report study. And as I read through it, I got to be honest, I was a bit upset in one way and also baffled in another way. So upset because I thought, gosh, with all the knowledge, information, and the data we have, and the low interest rates and everything that's going on, to see some of the abuse that happened that was found through this study was appalling. The other one was, why are people, this is the question that kept coming to mind, David, why are people falling for this? Like, what is going on here? How can people purchase cars with, people with good credit, purchase cars with high interest rates and have no clue when they walk away that they've just made a big mistake and not find out until months later when the payment is just, crushing them. So I was a bit baffled and, of course, frustrated to see this happening. And it really made me think, what can we do, even in our small area of influence, to help at least our listeners to understand some of the basics that are just necessary. It also brought to mind something that I've been studying quite a bit and looking at: how do we impact the younger generation and help them to manage money better? I believe younger generation, Gen Z, Gen Y, are very interested in finances, but they're getting overwhelmed with bad information, and specifically done, we'll talk about this, where there's a certain amount of information that's offered and other information completely left out. And that makes them ill-equipped to make a good decision because there's again, a lack of education. So here's some of the statistics of this study. First, or actually an investigation, it wasn't really a study, it was an investigation. So they found that interest rates charged were as high as 25%.
That's unbelievable.
Yeah, it's unbelievable. 25%.
The fact that even exists out there.
Yeah, even credit cards are less than that in some instances. 25% when the average loan was around 4.5%. That's what the rate should have been.
Yeah, I mean, that's like industry-wide statistically, when you average the people who have great credit and the people who have bad credit, 4.5% is a good average car loan. And you can get lower and you can get higher.
Sure.
But the fact that someone out there, and this is across 17 major auto lenders, this isn't just one person, the fact that some places were pushing loans to 20 and 25% interest is staggering. Just hold on to that thought. Okay, keep going, Leo.
Yeah, another statistic was that they claimed that 46% of the 800,000 plus loans reviewed were underwater, which what this means is, and by the way, the owners were at least $3,700 on average
Underwater.
underwater, meaning that the car was worth $3,700 average less than what they owed on it, which means they couldn't walk away from the loan without owing $3,700 or more.
46%
Yep.
of these 800,000 loans.
Yep, nearly half of them.
So as you're driving, you're probably listening as you drive into work. I hope that you listen every morning when you drive into work to Getting Money Right. But as you're listening and on a jog or on a drive, look at every car that drives by you. 50% of them, 46%, but yeah, half of them are upside down on their car loan. They owe more than it's worth. Just let that sit in your mind. Some of these stats are crazy. Okay, Leo, keep going.
So a major reason why Consumer Reports believes that dealers are lending in this way is because, frankly, they think that they can get away with it. That's what they're doing. They're just basically looking and saying, how much could we charge? And that's why you're seeing this. So there's a lot of abuses going on here. The other thing that the study shows that many borrowers don't know that they should or that they can negotiate the terms of the loan. Or even shop around for others, which is really remarkable when you think about the access to information we have today. I can pull up any car on multiple websites and find out what the average cost is if I buy it from a private party, whether I buy it from a dealer, or if I trade in my car. All of that, I can find all that information, and yet people are being taken advantage of. So it's really shocking to see that happening, and it's actually the reason why a lot of these 17 lenders either didn't respond, or the ones that did respond, their response was, the consumer has access to all the information. All they have to do is look it up. So
Yeah, they're
yes,
like, don't blame us.
That's
the
true.
consumer signed on the dotted line. It's the consumer's fault.
Yeah. So that's a cop-out, obviously, because there is such thing as responsibility in lending, and certainly they're abusing it.
Let's stay on that for a second. This is a really big deal. There's individual responsibility, which Leo and I believe highly in. You as an individual need to do the research. If you get a loan, if you get paperwork on a big deal, you need to read it. Now, on the flip side of that, if we saw that the average loan rate was around 4.5%, there will be people with bad credit that probably pay 10%. There will be people with great credit that probably pay 1%. That's okay. That's within normal lending practices. But when you start to go extreme and charge 15%, 20%, and it says it's not because there was a higher risk on the loan. It's because the lender knew they could get away with it. They were pushing the envelope. How much can I sell to this person and make them pay more than they actually should? That's what's called usury. Usury is extreme or excessive interest on a debt or a loan, and it's wrong. Now, this is very nuanced, because if let's say you handcraft, pumpkins for Thanksgiving and fall decorations, and you buy the pumpkin for $1, you handcraft it, you carve it, you sell it for $10. You're not wrong for marking it up $9. You should make a profit on a product. This is not bad.
You're adding your labor in.
You're adding your labor
considerable.
These companies are taking a risk when they loan money. They should add a profit margin in.
Of course.
There's nothing wrong with that. But let's say that you're selling bread and milk and basic necessities, and you realize, okay, it only cost me $1 to make this. I can earn a good living charging $2, have a 50% profit margin, everything is fine. But I'm going to go ahead and charge $10 for each gallon of milk and for each loaf of bread. Okay, just because you can doesn't mean you should. The individual business owner does have an individual responsibility to look to serve people. Now, this is nuanced because in our capitalistic society, you're allowed to go as far as you want to make profit, and I lean towards allowing people to do that. But each person, each company should be looking around and saying, okay, how can we serve our clients? And obviously, if you're a publicly owned company, you have to serve your shareholders. Those are your clients too. But man, there has to be a little give and take here. And what we're seeing here is the extremes of 15, 20, and 25%. It's just not appropriate.
No, it's not. And the other thing that was interesting about the study or the investigation was that with a lot of these folks, there was a high probability of default. It was known when they actually signed the loan, the lender knew that it wasn't matching the standards of what would be a safe loan
Their
for the
ability
person.
to pay. They knew
Right,
the person
because
wasn't going to be able to pay for this loan 3 months from now.
right, because the standard is, you're not supposed to spend more than, I think, 14% or something like that, 10% of your gross income. And these were 15% or more, sometimes as much as 25% of your income.
Right.
Now, you guys, if you listened to us for a while, you know that we suggest that your housing should be somewhere between 25 and 30. But that also includes your utilities, it includes all of your housing costs, not just your rent, not just your mortgage, but everything.
Yeah.
So think of your car loan being that high.
It's crazy.
It's just unbelievable.
You have to live in your car at that point.
Yeah, I mean, obviously, that would, hopefully it's a nice car, but can't be that comfortable.
Yeah.
Sleeping in your car. I don't care how nice it is. But here's the other statistic: the total auto loan debt held by Americans has increased dramatically over the last 10 years. Not only has the increase gone up 25% over the last decade, meaning a car that was worth, let's say, $10,000 10 years ago, today that car's worth $12,500. So it's gone up 25%.
Yeah, you might have bought a brand new car for 20 grand. Now you're paying 25 grand.
Right.
It's a 25% increase. You might have bought a used car for 10 grand. That used car is going for about 12.5 now. So, the cost of cars is going up, some on inflation, some on added, technology in vehicles. But consumers, Americans, keep paying more for cars. We're not demanding cheaper vehicles, which we could. Instead, we're taking longer loans and buying more expensive cars. We're utilizing debt to buy more expensive cars instead of letting the pressure of the price cause us to say, no, we're not going to pay that price, and then slowly pushing the price down in vehicles. The price of vehicles is going up.
Yeah, and when consumers allow this to happen to a certain degree, we have to take responsibility for that. But
big time.
At the same time, in that 10 years since the increase of the 25% from 10 years ago, the loan debt has gone from 700 billion to 1.4 trillion. So it's doubled in the last 10 years.
This is the total U.S. debt on cars is 1.4 trillion dollars. Australia, the country of Australia, does not, like, all their goods and sales in a year, it's called gross domestic product, all the goods and sales that they sell for the whole country in the whole year, the GDP is less than $1.4 trillion. And we as a country have that much debt in our cars. Yeah. It's borderline hilarious and absolutely tragic that the system we live in encourages us and allows us to be so in debt on something that goes down in value. Leo and I have both borrowed to purchase a home, but that goes up in value typically. Cars go down in value. The fact that our consumeristic mentality in the marketing in America has driven us to go this far in debt as a country towards vehicles is pretty staggering.
Yeah, and the car payment now is nearly $600 a month. Again, another 25% up from a decade ago. And what's really hard here is that as car prices go up, as monthly payments go up, as the loan is extended to make that happen, it's making it more and more impossible for somebody to actually buy a vehicle by saving and then buying it outright. So this is part of the problem. It's that you don't have the means to buy a car for cash unless you're buying something that's like 20 years old. Our daughter and son-in-law recently purchased a minivan. They've got a growing family, and the minivan just makes sense at this point. And they were looking at what minivan they could afford, and they tried to buy something under 100,000 miles. A couple of 3 different models that we were looking at. And I honestly, because I help them with this kind, I'm a car guy, so this is something they asked me to help with, and happy to do so. And as I'm going through, I told them, I said, look, here's what it's coming down to after the researches. You either buy a car that's at least 13 to 14 years old, that has just over 100, maybe 130 to 150,000, and you're going to pay around 10 to 12. Or you go under 100,000 and you're looking at about an $18,000 to $20,000 car. So the difference is $6,000 to $8,000. It's significant. And, I don't know anyone that says, well, I think I'll spend an extra $8,000. No, when you go to purchase something, you have a specific dollar value in mind that you're thinking, okay, I'm going to buy a $10,000 car. I have enough to buy a $15,000 car, or I can afford hopefully a payment with a little bit of down payment, and 15 is the max I go. Otherwise, the payment gets unhealthy. And that's where used cars have gone, and now new cars are almost. I just cannot. I can't understand. This is maybe
No.
I'm just getting old, but I can't understand an $80,000 car like an SUV. I just don't understand that.
Well, this is a big deal. We'll go through the numbers in a minute, like the actual percentages and guidelines. But according to Leo and I's estimates on your vehicle being somewhere between 10 to 13% of your monthly income, and we're going to go a little bit high with these estimates. Let's assume you do 15% of your monthly income going towards all your transportation in your household. At $600 a month for a car, that is like somebody who earns statistically around $200,000 a year. This is what I'm saying here is if you earn $50,000 a year, you probably shouldn't be paying more than $150 a month on your car.
Mm-hmm.
If you earn $100,000 a year, you could afford up to $300 a month on your car. By the time you're trying to pay $600 a month on a single vehicle, you should be earning 200 grand a year. That's the like debt has allowed us to spend as if we earn way more than we actually do.
Right. That's right.
And I say it's allowed us. The truth is it lets you get the loan, but now the whole rest of your life, your finances are pinched. And we'll walk through the numbers in a minute, but I just want to put how crazy that is. If you got a $600 car loan, I hope you have a $200,000 a year income in your household. And we'll walk through the numbers. There's a nuance to this, but that's crazy.
Yeah, it absolutely is. And here's the other part of it. With most borrowers, they pay their loan on time with no problem.
Mm-hmm.
Now, that doesn't mean that the loan isn't difficult, and it doesn't mean that it's not impacting them on a financial basis, meaning month to month, this is hard to make the payment. It probably is, but they're not defaulting. They're being responsible human beings, and they're paying for their debt. But this is actually, to me, even much worse because they're sticking to something that's actually every single month hurting them financially for the long term.
Painful.
And so, again, it might sound like we're trying to say never buy a car, never have a payment. Of course, the first one is not true. We all need transportation, a car you need to buy. What's interesting and what caught our attention with this investigation and some of the things we've been reading is the lack of education has caused people to fall into these things. The fact that someone with good over 700 credit score can be talked into buying a car on car loans that's an interest rate that's 17 to 25% is clearly saying something's missing here. This person did not know. They didn't sign it willingly or knowingly. They were told something and they just bought it because they didn't have the information they needed. So one of the things we want to talk about going forward just for a few more minutes is the personal responsibility we have to understand when we get into a situation that requires making a financial decision. Cars are a big deal. One, when we buy them, it's not something we can change out all the time. Just like a house, you can't just flip and flip and flip because every time you make the transaction, there's costs involved. Same thing with a vehicle. So you want to buy something that you can over time average a lower cost so that it's affordable, it's within your budget. And so what we're trying to do is to educate people to understand what that number is by having a budget in place and being able to say, I know I can handle this specific payment. But we also have gone way beyond that in our education through this podcast, which is to say, when you buy something, it's always based on value. What that means is not just moral value or what I like. No, we're actually talking about dollars and cents. What is the value of this vehicle to you? And if you don't know the cost of it, you cannot know the value of it. And what we're seeing from this study and some of the other things that we've been reading is that people lack the ability to understand the actual cost. Unfortunately, because we've been, probably for the last 40 plus years now, been marketed in such a way that you can afford this in a low payment per month, that the actual value is not considered as much as it used to be. When I first bought my car, it wasn't about a car payment. How much is the car?
How much is the cost?
Don't tell
of
me
the
how much it is
actual
per
car,
month.
right.
I want to know how much is it in value because I'm not going to overpay you.
Right.
So I took it upon myself to say, I know how much I can afford. And even if I choose to take it in payments, that doesn't mean I'm going to pay you twice what it's worth. That's
Right.
just foolish, in my opinion.
Let's give an example here because, like Leo said, let's say that you're going shopping at a car dealership and you look on the lot and it doesn't tell you the dollar value of the car, $10,000.
Mm.
It tells you the monthly payment,
Yeah.
$300 a month. Okay, you look at your budget. I can afford $300 a month.
Yep.
Just going to go buy this car right now today, without ever asking. This is a $10,000 car. Okay. What happens is you don't have the actual value. This is where you need to do your own research.
Mm-hmm.
You research the year, the make, the model, the mileage. You plug it all into Kelley Blue Book or Edmunds, and you get the value of this car. You need to know the actual value, because what happens if you just go off the $300 a month? You get into the financing, they print out a piece of paper, says, hey, all you got to do is pay $300 a month. You look at your budget again. You're like, I listen to Getting Money Right. I spend on purpose. This $300 a month fits into my budget. Great. But what you don't realize that you've just signed is, let's say it's a 15% interest rate. And these aren't exact numbers, but let's say it's a 15% interest rate over 6 years. I mean, 300, and I'm making this up, but $300 times 12 months is $3,600.
That's right.
And let's say that you did $3,600 over a 5-year loan. That means 3,000 times 5 would be 15,000. 600 times 5 is 18. Okay. $18,000 that you've just agreed to pay for a vehicle that was worth $10,000. But it's because you only looked at $300 a month times 5 years, and you didn't even look at that. You just said, I can afford $300 a month. Mm-hmm. This is the difference. You need to know what the actual value is, and then you need to look at the loan terms and say, am I going to pay? Now, maybe, I'm borrowing money. I probably will end up paying $11,000 for this $10,000 car. That's probably okay. I may spend $12,000 for this $10,000 car because of the loan and the borrowing money. That could be okay. You spend 18 grand, you spend an extra $8,000. Now, here's what's funny. Almost immediately, the car starts going down in value, but your loan doesn't go down quickly. You have 5 years to pay off on this thing. So, within a year, your car is worth, 8 grand, but you still owe 17 grand on it. Like, you're actually going backwards as you're making payments. That's what happens on a new car. On a new car, you go backwards immediately. And that's where you see 50% of cars being upside down to the tune of $4,000. It was like $3,600, but I'm rounding the numbers here. This is staggering. This is the kind of stuff that Leo and I just look at and we say, please, if you're listening to Getting Money Right, and you want to get money right, follow the rules of thumb and walk this out. So let's share some of those rules of thumb. Before I get there, one of the writers and investigators in this article, this is how she summed it up. Her name was Kathleen Engel, and just props to Kathleen here. She says, you're not helping somebody get a car if you know that the odds are they're going to lose that vehicle.
That's right.
And that's what happens when you go upside down in a car. Eventually, you can't make the payments. Eventually, you have to sell it at a loss. It's a major, major financial disaster in somebody's life. Mm-hmm. She said, that's not getting somebody a car. Because people will say, well, I just loaned him money. I helped him get a car. I was serving the customer, and they signed the deal. No. This is a direct quote. She said, that's taking their money. You are basically stealing. That's unethical because they can't afford the car at the rate that you've given them. You look at because they won't lend money unless they look at your budget to some extent. They look at your income, they look at your current debt loads. Mm-hmm. So they have a basic understanding of your finances. And if they choose to lend you money that they know you can't afford to pay back, and eventually they're going to repossess the car, they're going to resell the car, make another profit on the car after they've bilked you out of, $4,000 or whatever the money ends up being. Guys, not every car dealer is like this, but the fact that there are some should cause you to be very, not only there are some, but 50% of people have fallen into a place where they're behind or upside down.
It's a bigger problem than, just one or two bad dealers out there.
Right.
The reality is we live in a society where if somebody can get away with charging you twice what you should pay for something, it's maybe even looked on as you're a smart capitalist. And again, what David said earlier about the moral obligation that we all have, we'll all have to give an account for that, I guess. If you could sleep at night and do that, I guess I couldn't. What's sad to me is that, yes, this is happening. I don't agree with it. I think it's just despicable in my mind. But at the same time, I think what's happened with the individual person who has access to information, who has parents that should have been teaching them more, or has friends that maybe car people or anyone. Gosh, if somebody came up to me and said, "Hey, I'm thinking about buying a car. Here's what I'm thinking," I would take the extra 15, 20 minutes to just do a quick Google search and give them a couple of pointers, because I would not want that person to be taken advantage of.
Yeah.
So again, it's up to us individually to learn and to be educated and be informed before we make a decision. This is why we exist here, is to help you not only to understand the information, but to understand where it applies and how to use it. But it is important that we understand the value, that we understand what it actually going to cost us, not just a monthly payment. And the only way that you and I can do that is to have a plan. We need to have a what we call a budget, so you can make an informed decision and keeps you from making a potentially bad financial decision that won't keep you financially safe. And then, as often as possible, try to lower the cost of what you're buying. In other words, get the value you need, but don't overpay for the value, right? When my daughter and son-in-law bought this minivan, they had the means, they could have paid cash for it out of their savings account to buy a car that was newer, nicer, whatever. But they said, no, we need a vehicle to transport our family. This is not going to be our forever car. There's no such thing. And we don't want to pay $20,000 for this. We have other goals, and so we only want to spend about 10. And they were able to find something under $10,000 that is the value that they need, which is to take them A to B and provide the transportation their family needs. So my point is, you do have the ability to do that. So think about, how can I pay cash or pay part of it cash, so that in time you no longer have to deal with the loan industry that could potentially do this to you.
Yeah, and we referenced capitalism a few times. Let me say this. Individual greed is the problem at some of these companies.
Absolutely.
But let me tell you what the answer is. Capitalism.
That's right.
Capitalism is actually the answer, because here's what will happen. As these companies are greedy and are overcharging people, what it does is it allows new competitors to come into the marketplace and have good business practices. Because if you get burned by one of these major auto lenders where you end up upside down in the value of your vehicle, you're spending 15% on interest, it's absolutely ridiculous. There's going to be whole industries of people that are creating small auto loans that are inexpensive and are based on true finances, and they will earn a profit, and these big expensive places will go away. So the competition of capitalism will solve this, but the other side of that is that the individual consumer has to go and get the information. And guess what? Capitalism solves that, because here Leo and I are giving you this information, quote unquote, for free on the Getting Money Right podcast. We're a part of the capitalist society. You have advertisers, you have the sale of financial courses. We benefit as we share information with you that help you make better decisions to avoid the greed of an auto lender that's unhealthy. That's part of the capitalistic society. So when we reference capitalism, it's actually the answer to this problem. But the most important, quickest answer in your life is for you to get educated. Don't wait for the whole system to get fixed by capitalism. You go after the answer in your own life. So let me give you a few recommendations. Now, this is a little complex because these are numbers and this is a podcast. And I realize that. So I'm going to try to go a little slow, but I think this is extremely helpful for you as you think through. First and foremost, this is a great rule of thumb. This is something that you should abide by in your life. The total value of all the motor vehicles in your household should be less than 50% of your annual income. So let's say you have $100,000 annual income. 50% of that is $50,000. That means that you should not have more than $50,000 worth of vehicles in your household. And the reason is because vehicles, anything with a motor in it, goes down in value over time. And if you have that much of a percentage of your annual income tied up in things that go down in value, it's detrimental. So let me give you an example. Let's say that you have $100,000 of income. That means $50,000 is the max of vehicles. Let's say you need two cars. That's two $25,000 vehicles. Now 50% rule is the maximum. That is like you're right on the line. Like I like to be conservative and bring it down to the 40% or 30%. Ashley and I have always stayed under the 30% rule, not the 50% rule. Like, no, let's be conservative. So, Ashley and I, and this is just to give example of that it's doable. Ashley and I, when we first got married, we bought her a $5,000 vehicle and she drove it for 4 years, meaning that you can buy a $5,000 vehicle and it'll be okay. You're going to live. A few years into our marriage, we bought a $9,000 vehicle for me because we had a little bit more margin. So we bought a $9,000 vehicle. I drove it for 7 years. What I'm saying here is that you can actually drive $5,000 cars, $9,000 cars. You can be just fine. Leo just gave the story of how his daughter and son-in-law bought a $10,000 car and they're doing great. The total value of our vehicles for that 5 to 7 year period was like $14,000. That was below the 30% threshold. We didn't even come near the 50%.
Right.
Okay, so that's one rule of thumb. Don't have motor vehicles that are more than 50% of your annual income. Honestly, I say be conservative and go for 30%.
Or less. Yep.
Or less, right?
Because you can. See, the reality is you can find good used vehicles that can keep you in that safe zone and still have the value of having a good, reliable car.
Yeah. Now, the next thing that you want to be thinking of, this is really big, is your monthly cost of transportation. So you need to look at your budget. This is where we spend on purpose. And in our creating a budget tool, actually our spending on purpose tool really is what we're calling it now, is an overview of what you should spend percentage-wise in different categories. Now, just a general rule, you should not be spending more than 15% of your monthly income on all of your transportation. Leo and I like to target 10 to 13%. Again, because we're conservative and we like to buy things a little cheaper, have more margin. Rule number 3 is increase your margin. So I'll give you some numbers. Let's say you have a $4,000 monthly income. That's about $50,000 a year of income. If you have $4,000 a month, that means your total transportation should be $600 a month. Now that's total for the whole household.
Yep.
Let's say you spend $200 in gas. Let's say you spend $100 in maintenance. That leaves you $300 left for actual car payments. Let's say you need 2 cars. Each of those cars can only be $150 a month car payment. That is about a $10,000 vehicle, maybe like a $9,000 vehicle, honestly, but it's about a $10,000 vehicle. That means if you have $50,000 a year of income, you could probably afford 2 $10,000 vehicles in your household. Now, let's run that against the other percentage. 2 $10,000 vehicles is $20,000. That is less than the $50,000. That's less than half of your $50,000 income. It doesn't break the 50% rule.
Right.
You're okay here. Okay, I know there's a lot of numbers. I'm going to throw one more at you. That was $50,000 of income, saying that you could have 2 car payments, each at $150 each. Well, let's say you have $100,000 of income. You double your income. Now you could afford a $300 a month payment on both of your vehicles. Let's say you have $150,000 a year income. Now you could afford $450 a month on your car payments. This is where I got to the fact that by the time you get to $200,000 a year of income, that's when you can actually safely afford $600 a month towards a vehicle. And what we saw, Leo, in this study is that the average spending per month on a vehicle is $600 a month on a new car loan. It is absolutely staggering because I guarantee you the average income in America is not $200,000 a year.
And just to clarify, because we want to make sure the numbers stay correct. So that would be for 2 vehicles.
2 vehicles in a household.
Yeah, $40,000 vehicles. So it would be 2 $600 payments. Is that correct?
Yes, 2 $600 payments. Yeah, and so technically
it's $100,000. For every $100,000, you can afford up to $600 a month. Okay, and that's a $30,000 vehicle. This is where you can kind of think, okay, well, what can I buy for a $30,000 car today?
Yeah.
I mean, what are the cars that people are seeking today? SUVs, maybe a Tesla Model 3. None of those are
No.
30,000.
No.
They're not even close.
No.
Right? So you're going to buy a Mazda, a smaller Chevy,
used
SUV,
Toyota.
something like that. So the $600 a month is just not going to get you a ton of vehicle. But that's why you see these loans that are $800, $900 or more that take up more than 50% of your income that put people in these kind of situations. And that's why the study showed 46% were underwater.
That's right.
And I think that's probably a very accurate number across the board. And I know they only studied 158,000 loans, but my guess is if they would have expanded it, they would have found probably the same thing by and large.
Now, again, I'll give you one more example just to show you that you can do this. For Ashley and I, and these are really close numbers, not exact. I didn't look at my budget right before I came over here, but we spend about $200 a month on gas, maybe a little more, maybe a little less, but about $200 a month. We save about $100 a month towards maintenance because we both have used vehicles. That's $300 a month. And then we set aside $250 a month in cash to then pay for new vehicles, not new, used vehicles,
for the
in
next
cash,
cars you can
for
buy.
our next car in cash.
Right.
So we don't have any car payments because we pay in cash. $200 in gas, $100 in maintenance, $250 in our savings every month to then set aside and buy new vehicles. That's still less than $600 a month.
Yeah, you also have insurance in there,
And
tags,
insurance
there's a
and
couple
right, yeah. So there's a few other things that are in here, but
there's basically 5 things. You have gas, not including car payment, gas, insurance, tags or inspection,
yes,
and then repairs. And of course, the car payment would make 5.
right. So, and with our car insurance, let me just hit this off the top of my head. I think it's about $100 a month for both vehicles. So now we're stepping into the $650 range per
Ours
month.
is right around $700, which again includes about $250 toward the next car payment.
Right. So that's our total transportation cost per month. That would be, in this example I used below, in a conservative way, somebody living on about $50,000 or $60,000 a year. We earn more than $50,000 to $60,000 a year, and yet we still live like someone earning $60,000 a year. Right. All I'm saying by this example is that even people who make more money than $60,000 can still live conservatively. What that allows Ashley and I to do is it allows us to save extra into our retirement accounts. It also allows us a little bit of extra free spending money that we can go have great date nights and have fun. And if we want to buy clothes, if we want to buy Starbucks, we have more entertainment money because we've kept our vehicle lifestyle lower. Now, our vehicles are both used vehicles, but they look nice. They're still clean. We still take good care of them. So we're not suffering, and at least not by my experience. Somebody else may be like, wow, I don't want to drive a 5-year-old vehicle. Like, guys, it's not that bad. Eventually your vehicle is going to be 5 years. If you buy a new vehicle and get a 5-year loan, eventually it's going to be 5 years old anyway. So might as well buy it 3 years old and ride that down a little bit.
Well, let me give you a personal example here. A friend of mine texted me the other day and said he found a vehicle that was going on sale, and it was the same year as a vehicle he owned. The only difference was this was a different model, and it only had like 9,000 miles on it.
Wow.
This was a 2003. I'll go ahead and say it was a Porsche 911. He has a Porsche Boxster. So this is 911, which is 911 is obviously a better Porsche, a lot more expensive as well. But they wanted $42,000 for it. So he said, hey, I'm thinking about this. What do you think? And we've been talking about him wanting to buy a car every once in a while. And then he always doesn't because he's a good steward.
Right.
And he sees that as a little too extravagant. So anyway, we go to look at this car. We go down to Dallas and look at this car. And he sits in it. He looks at it. We talk to the salesman and all that. We get done. We leave. The next day, we had breakfast. So I asked him, I said, so where are you at with the car? And he said, yeah, I decided I'm not going to buy it. I said, well, why? He said, when I sat in it, I realized the interior is exactly the same as mine. Like literally, it felt like I was sitting in my car.
Yeah.
And he said, the only difference is what people will see from the outside.
Wow.
From the inside, it's going to look the same way as I drive mine.
Wow.
And I thought, that's brilliant. I mean, that's right there. That's brilliant. His perspective is not going to change. Others people's might. But this is where the rub is sometimes when it comes to cars, is that we care more about how people view us from the outside looking in rather than the way we portray ourselves looking out. And so David just said he's in a 5-year-old car, and some people might think, oh gosh, 5 years old, why would you drive such an old car? Mine is 20 years old. I really don't care what people say about what I drive. That's not how I make decisions. It's not that I don't care about people, but I just don't let that, their perspective on me make decisions for how much money I spend on my vehicles. But my point for all of us that are in this, and all of us are, we need to make decisions based on what's healthy for us.
Mm-hmm.
What we can afford, what's of good value, what makes us fulfilled. I don't want to drive in a car that I'm wondering if it's going to make it to work.
Right.
But I also don't need to drive in a car that everyone has to turn around and look at. I don't need that in my life. And I'm certainly not going to pay the premium to have that kind of reaction from people.
Right.
But again, this is something we all have to deal with. And our hope for you is that as you understand this information, you walk away with two things. One, become more educated. Mm-hmm. When it comes to this car decision, house buying decisions, these are the biggest expenses we make. We need to be educated. We need to understand. Or we need to just ask someone who knows. Don't be afraid to ask somebody who's a car guy, hey, I'm thinking about buying a car. I would rather pay you for a couple hours of your time to come with me than for me to make a big mistake. Mm-hmm. And people probably won't charge you for it. But, and honestly, car guys love to talk about cars. So if you pull us into the equation, we'll probably spend more time on it than we should. But my point is, don't go in there without having the proper knowledge or the right support so that you're making the right decision. And then the second thing, make sure when you're making that decision, it's based on a plan. Make sure that you know what you can afford. Walk away from this month-to-month kind of education.
Right.
What you can afford per month has nothing to do with the actual value 9 times out of 10. So take both of them into account. Consider how much is this going to cost me long term, and then make sure it fits into that percentage of your budget. That's why we created Getting Money Right, is to help you understand there are some guidelines there that can help you, but overall find ways to hack life a little bit. Find ways that you can find life hacks that'll help you to get just as much value for a lot less, and then use the rest of it for the things that really matter. Spending time with your family, investing in the things that you care about. And I think you'll be much more fulfilled than driving a brand new car that's going to feel like a weight that you're dragging on for 5, 6, 7 years. That's just a burden I do not want to carry, and I don't want anybody to carry.
Right. Well, I hope that you're enjoying this episode, and that you will take a moment to go onto our Instagram, our Facebook, to hit even on either Apple or Spotify or Castbox or Stitcher, wherever you're listening to this, hit the heart button or the like button. Download 2 to 3 extra episodes to queue those up for your next jog or your next drive, or as you're doing dishes in the house. We are so grateful for you tuning in and listening. It helps us so much when you hit the like button or that you subscribe to the channel. It lets the algorithm know that this is a valuable service, and that means a lot to us. So thank you so much for doing it. Leo, where can people come hang out with you a little bit more?
Well, they can come to leosable.com. There's resources there. It says content. I do have some articles on buying a car, and actually we've done even some podcasts on that. So feel free to use that information, gather that information, and hopefully it'll help you in the next car purchase. But just, again, you can come to the website. There's a lot of free resources there for your benefit.
That's right. Well, we look forward to having you join us next time. So together, we can keep getting money right.
We need to make decisions based on what's healthy for us. What we can afford, what's of good value, what makes us fulfilled. I don't want to drive in a car that I'm wondering if it's going to make it to work.
Right.
But I also don't need to drive in a car that everyone has to turn around and look at. I don't need that in my life. And I'm certainly not going to pay the premium to have that kind of reaction from people.